We're jumping straight into Ichor holdings today. Everyone is watching the price action, but the real story is the turnaround guidance for Q1 2026. I know, looking at a chart that just hit a new 52-week high is exciting. You see that line just climbing after the Q4 earnings beat, and your first thought is, okay, I missed it.
Or, this is going to the moon.
Exactly. But we really have to look closer. While the Q4 revenue came in at $223.6 million, which was actually down a little from the last quarter, the guidance for Q1 2026 is what matters. They're setting a floor of at least $240 million. That's the signal.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us. And it really is about looking past that headline number, you know? You have to understand the mechanics of why the price is moving.
And we're here to simplify that complex data so you can actually use it. So if you want to keep getting these market breakdowns, make sure you subscribe and hit the like button. It helps us make sure you aren't trading in the dark.
Let's get into it.
Okay, let's unpack this properly. I was looking at the charts, and Ichor is definitely capturing the market's attention right now. But I want to start with the why. Why are investors piling in? We mentioned the guidance, but what does this company actually do to justify all this excitement?
Well, that's the thing. If you go to their website, you see all these industrial photos and, phrases like fluid delivery subsystems.
Right. It doesn't exactly scream hot tech stock.
No, it doesn't, but that's often where you find the really interesting plays. To put it simply, Ichor is basically the high-tech plumbing of the semiconductor world. I want to be careful with that word plumbing because it makes it sound trivial. It's not.
Okay, so when you say plumbing, I'm guessing we're not talking about PVC pipes under a sink here.
Far from it. Think of it more like the vascular system of a living thing, except that living thing is a multi-million-dollar machine making the most advanced chips on the planet. We're talking about the critical systems that deliver gas and chemicals for semiconductor manufacturing.
So things like etch and deposition. Break that down a little for us.
Sure. So making a chip is like building microscopic skyscrapers on a tiny piece of silicon. Deposition is adding the layers of material, and etching is carving the super intricate patterns into those layers.
I'm with you.
Both of those processes need these ultra high purity gases delivered at like perfect flow rates, perfect pressures. If this plumbing fails or is even off by a fraction of a percent,
You ruin the whole batch.
you ruin millions of dollars worth of wafers instantly.
So it's absolutely mission critical. You can't have a leaky faucet in the clean room.
Not a chance. And that leads to what I think is the strongest part of the bull case here, the moat, the competitive advantage.
Right. What stops a huge chip manufacturer from just, finding a general supplier to do it cheaper? Or just build it themselves?
It's not going to happen. The barrier to entry here is all about what we call switching costs.
Okay.
Because these parts aren't off the shelf. They're proprietary, they're precision machined, they have complex weldments, they are tailored specifically for that customer's equipment.
So once an OEM, an original equipment manufacturer, designs Ichor's systems into their machines, it's really hard to switch out.
It's incredibly difficult
Yeah.
and risky. It's all about the copy exact philosophy in this industry.
Copy exact.
Once a process is qualified and it works, you don't touch a single thing. You don't change a screw, let alone the entire gas delivery system.
So if they wanted to switch suppliers, they'd have to redo all the testing.
They'd have to requalify the entire process. We're talking millions of dollars and months of work. It's not worth the risk for them.
So they're locked in. I love that. It's sticky revenue.
Yeah.
Once you're in the machine, you stay in the machine.
Precisely. And it seems like the smart money really agrees with this. I was looking at the ownership structure, and this number is just, it's wild. Institutional ownership is at 97.28%.
Wait, 97%? That leaves almost nothing for the retail crowd.
It's massive. And when you see institutional ownership that high, it tells you the big funds, the ones with the huge research teams who actually go visit the factories.
They have high conviction.
Very high. They are heavily involved. It signals that they believe in this turnaround story for the long haul. They're parking capital here, not just flipping a stock.
And speaking of capital, let's talk about the balance sheet.
Right.
Because you can have a great story, but if you're drowning in debt, well.
It doesn't matter. The market will find you out.
But Ichor looks pretty clean here. They have a current ratio of 3.08. For anyone listening who doesn't track that stat, what does that really mean?
It's just a measure of liquidity. It means for every dollar in bills they have coming due in the next year, they have $3.08 in cash or things they can quickly turn into cash to pay for it.
That's a huge buffer. It's like having 3 years of rent in the bank.
It is. And their leverage is low, too. Debt to equity is just 0.24, which is crucial right now because borrowing is not cheap.
Right.
So that low debt gives them breathing room to survive a downturn, but more importantly, it gives them the capital to actually grow. They're not just servicing interest payments.
Which is a perfect segue into the future growth drivers.
Mhm.
We hit on that Q1 guidance of $240 million, but management is projecting confidence way beyond that. They're saying their revenue growth in 2026 will actually outpace the entire semiconductor industry. That's a bold claim.
It's very bold, and it comes down to two things: capacity expansion and technology transitions. They aren't just waiting for orders, they are actively building new facilities in Mexico and Malaysia.
Now, that usually makes me a little nervous. Building new factories burns a lot of cash in the short term. It's expensive.
It is, but this is strategically necessary. We've all heard about the China plus one strategy.
Supply chain resilience.
Exactly. The big tech players want manufacturing closer to home, so near-shoring in Mexico, or in stable hubs like Malaysia. ICHR is putting themselves right where their customers want them.
And the real kicker, I assume, is what this does for their margins.
That's the key, margin enhancement. Yes, it costs money up front, but once these factories are ramped up, they're designed for efficiency. Labor costs are favorable, the facilities are state-of-the-art. So the bull case isn't just that they'll sell more plumbing, it's that they'll make more profit on every single unit they sell, starting around mid-2026.
That's the sweet spot. Revenue growth plus margin expansion, that's operating leverage, and it almost always leads to a higher stock price. And yet, despite this recent rally, the valuation, they're trading at a price-to-sales ratio of 1.19.
Which is remarkably low for this sector.
Right. For a company tied to AI infrastructure, to semiconductors, that feels, I don't know, maybe even undervalued.
It's a compelling argument. I mean, you look at the big AI chip designers, they trade at 20, 30 times sales. To pay just over 1 time sales for a company that's a critical part of that exact same supply chain, it suggests the market hasn't fully priced in that 2026 growth story yet.
It sounds almost too good to be true. Sticky customers, huge institutional backing, new factories, reasonable valuation. But, we have to look at the other side of the coin. If it was this perfect, this stock would be at $100 already.
Right. Looking at the flip side, we have to talk about the risks. And there are significant ones.
Okay, let's start with volatility. Ichor has a beta of 2.07. Break that down. What does that number mean for the person checking their phone on lunch break?
Beta just measures how a stock moves compared to the broader market. A beta of 1 means it moves in sync. A beta of 2.07 means Ichor is basically twice as volatile. So when the market goes up 1%, Ichor might go up 2. That feels amazing.
But the reverse is also true.
And that's the big warning. When the market drops 1%, Ichor is likely to drop 2. It amplifies the pain. It is not a stop for stability in a crash. It rises fast, but it falls fast.
And that volatility comes from the industry itself, right? This isn't selling toothpaste, which people buy no matter what.
Not at all. It is highly, highly cyclical. When chip demand cools off, the big guys, your Intels, your TSMCs, they cut their capital spending budgets first. And Ichor feels that immediately. You can't ignore the history here. Their revenue actually declined 11.9% over the last 3 years.
That's a really important reality check.
It is. We're celebrating this turnaround guidance now, but the trend leading up to this was not a straight lineup.
Even that Q4 revenue we mentioned, it was a beat, sure, but it was still a dip from the previous quarter.
It was. So the growth is still a promise. It's not a fully realized reality just yet.
And that takes us to profitability. You mentioned the margins as a future growth driver. But what do they look like right now? Because promises don't pay the bills.
Right now, they're thin. The gross margin for Q4 was only 11.7%.
11.7. That feels incredibly tight for a company doing this kind of precision work.
It is tight. It leaves almost no room for error. If raw material costs go up or there's a shipping delay, that 11% can just evaporate. There's no cushion.
And the return metrics look even worse. I'm seeing a return on equity of negative 5.88%. Return on assets is negative 4.13.
And that is the absolute core of the bear case. The company has really struggled to turn its revenue into actual profit recently. The whole bull case we just laid out, it relies completely on the promise that those new factories in Mexico and Malaysia will fix this. But that's a huge execution risk.
What do you mean execution risk?
Well, what if the factory in Malaysia takes 6 months longer to build than planned? What if they can't hire skilled engineers fast enough in Mexico? If those efficiencies don't show up on time, those negative return numbers are going to stick around, and the stock price will suffer for it.
It's a show-me story. They have to prove it on the balance sheet. And that brings me to sentiment. The stock's hitting highs, but the quantitative sentiment scoring is mixed.
It is. It's technically neutral. You have some bullish news, sure, but you also have analysts who, even while they're raising their price targets, aren't actually upgrading their overall stance on the stock.
Like with Oppenheimer. They moved their target up to $36, but didn't change the underlying rating.
Right, and let's look at those targets. The average is around $38.20. The stock is already trading in the mid-30s.
So a lot of the potential upside might already be priced in.
That's the danger. You're not getting in on the ground floor anymore. You're getting in while the elevator is already moving up, and it might be getting close to the top floor, at least for the short term. The market is pricing in a very smooth recovery.
So we have a clear picture, a strong moat and great forward guidance up against thin current margins and a history of volatility. If you're holding this or thinking about it, you have to know what to watch for in the next 30 to 90 days.
Absolutely. You can't just buy and hope. There are specific triggers to monitor.
First up, obviously, is that Q1 2026 earnings report. We're expecting that late April, maybe early May.
And the number to watch is that $240 million revenue floor. Management put that flag in the ground. If they come in at 235, the thesis breaks.
The market would see that as a failure.
A total failure of the recovery narrative. They have to hit or, preferably, beat that 240 number. No excuses.
And right alongside revenue, we have to be watching the gross margin trajectory.
We need to see proof. We need to see those margins start to tick up from that 11% range. As they get closer to launching the new facilities, we should see some improvement.
And if they don't, if margins compress further,
then investors are going to seriously start doubting that whole efficiency story.
there are also some events coming up. They're presenting at the 28th Annual Needham Growth Conference.
And these conferences can be catalysts. Management is in front of investors telling their story. It's often where you get little updates on facility ramps or maybe a new customer win. It keeps the narrative going.
And finally, the macro factor. We can't look at Ichor in a vacuum.
No, it's a small boat on a big ocean. And that ocean is global semiconductor capital expenditure, CapEx. We need to see news that the big chip makers are spending money again. Ichor's success is directly tied to that. If Samsung or TSMC announce they're cutting their spending budgets,
Ichor will fall no matter how good their story is.
Exactly. So keep an eye on the headlines for semiconductor CapEx.
This has been a really fascinating look at a company that usually flies under the radar. It just highlights how complex this whole supply chain is.
It does. It raises an important question for everyone listening. We spend so much time focused on the flashy AI chip designers.
The ones making the headlines.
Every single day. But is the real, maybe more stable opportunity in the companies handling the gases and chemicals required to build those chips? It's the classic pick and shovel trade.
The old gold rush analogy.
Precisely. You can bet on which miner strikes gold, or you can bet on the guy selling all the miners their shovels. In a gold rush, the shovel seller almost always gets paid. Ichor is selling the shovels. Or, in this case, the high-tech plumbing. The question you have to ask is, do you want the lottery ticket, or do you want the infrastructure play that supports them all?
That's the thought to leave you with today. Are you chasing the gold, or are you investing in the infrastructure that makes the gold rush possible? All right, that's the lowdown on Ichor Holdings. Keep your eyes on that $36 level and those mid-year facility ramps. If the margins start to pick up, this story gets very interesting. If they miss that revenue target, look out below. Thanks for tuning in to the Easy Money Show. We'll catch you on the next one.